Hello, everyone. Listen close, because what I'm about to lay out is not the kind of thing you can catch up on later. It's Sunday evening, January 18th, 2026, and while most people are watching highlights, doom scrolling, or telling themselves they'll look at markets tomorrow, the silver market's plumbing is quietly grinding into a position where one small shove could crack it wide open. And I'm not talking about some dreamy, vague, silver is undervalued speech. I'm talking about a very specific bottleneck, one that doesn't care about anyone's opinion, one that doesn't care about your chart lines, and one that doesn't care about what a talking head says on television. This is logistics meeting policy. This is math meeting reality. And it's the kind of setup that people only recognize after the move is already gone. Now, before we jump in, I'm going to ask you for something quick and direct. My YouTube analytics show that a huge chunk of you watch these videos, sometimes the full thing, and still haven't subscribed. If you get value here, hit subscribe right now and drop OG John AG in the comments so I know you're part of the core crowd that actually supports original work. All right, here's the situation. The mainstream financial media spent Friday evening painting a cozy picture for your brain. They talked about Greenland like it was a chess move, like it was diplomacy, like it was a bargaining chip in some clean little negotiation. Meanwhile, the real event, what actually matters for silver, landed after London was basically done for the week. Quietly, neatly. And that timing matters more than people realize. Because Friday night, the administration dropped the tariff announcement that most commentators are treating like a political headline, when it's actually a mechanical problem for physical metal. 10% tariffs on imports from 8 EU nations plus the United Kingdom, starting February 1st. And if a deal isn't reached by June 1st, it ramps to 25%. That's the frame. That's the schedule. That's the fuse. And yes, the list includes the UK, which means you're not just talking about Europe. You're talking about the home base of the LBMA ecosystem, the world's most important institutional silver hub outside New York, the place where paper promises are stacked on top of paper promises, and everyone behaves as if metal can always be sourced, somewhere, somehow, whenever it's needed. Now, let me say this clearly. I'm not asking you to believe anything. This is not a belief exercise. This is arithmetic. If you change the cost structure of moving metal between the two key venues, you can break the mechanism that keeps global silver pricing glued together. And when that glue fails, you don't get a gentle little wiggle. You get separation. In this video, I'm going to do three things. First, I'm going to explain the trap, how tariffs can create what is basically a one-way valve in a physical commodity market, and why silver is uniquely vulnerable to that kind of valve. Second, we're going to walk through the stress test math, not hype, numbers. What happens at 10%? What happens at 25%? And what price levels become required just to make the old flow work again? Third, I'll share the exact dashboard I'm watching into the Monday open and through the next 14 days. Because if you wait for the headlines to confirm it, you'll be paying the confirmation premium, if you can even get product. And quick reminder, check the description when you're done. I've dropped bonus links for you there, including the premium WhatsApp channel link and the channel membership link. If you want faster updates, behind-the-scenes notes, and the stuff that doesn't always fit neatly in a public video, those links are where you start. Now, let's get to the meat. As of late afternoon today, silver is sitting just under $90 an ounce, about $89.94 on the screen, with gold around $4,596. That looks calm, right? It looks like nothing is happening. It looks like a regular weekend pause. But here's what's different. While paper quotes drifted slightly, physical spreads began to widen. Not in a way that sets off sirens for the casual observer, but in a way that anyone who actually watches dealer behavior immediately recognizes. When bid-ask spreads widen, it's the market whispering that availability is getting tense and risk is getting repriced. And remember, the tariff news hit after London had already closed up shop for the weekend. So you've got a market structure where the biggest institutional venue for silver has to wake up into a new cost regime without having had a chance to respond in real time. That's how traps happen. That's how gaps form. Let's rewind for context because this matters. Earlier in 2025, we watched a major migration of physical silver out of London and into New York. It wasn't one little shipment. It was big. It was persistent. And it looked like smart positioning at the time. The banks and big players were front-running a policy risk, the Section 232 review process, the national security framework that can be used to restrict certain imports. Silver is a strategic input. It's in solar, electronics, medical gear, defense systems, and a dozen industrial supply chains that governments care about. So the thinking was, if restrictions come, keep the metal inside the US system. Move it early. Be safe. And now, with one announcement, the chessboard flips. Because the problem isn't just imports into the US. The problem is the economics of moving metal back and forth across the Atlantic in a way that keeps the pricing mechanism balanced. This is where the average investor loses the plot, because most people think silver is a chart. They think it's candles and moving averages and sentiment. But silver is also a physical flow market. It is pipes, vaults, refineries, shipping schedules, insurance, and settlement rules. When those pipes run freely, price stays synchronized. When the pipe is pinched, you can get two realities at once: a paper quote that pretends everything is fine, and a physical market that screams something else entirely. So let me teach you the key concept, because once you understand this, you will never look at silver the same way again. It's what I call the geographic arbitrage trap. Here's the plain English version. When the cost to move an asset between two major markets becomes greater than the profit from the price difference, arbitrage stops. And when arbitrage stops, the mechanism that equalizes price stops. And when that stops, you can get dislocation, sometimes violently. Think of it like this. Imagine you have two rooms in your house. In room A, you have the thing you need, your wallet full of cash. In room B, you have the bill due, right now. Under normal conditions, you walk from room A to room B and pay the bill. Simple. Now imagine there's a gate between the rooms, and every time you pass through, someone takes a chunk of your cash. At 10%, it's annoying. At 25%, it's brutal. Eventually, the cost of moving money becomes so painful that you hesitate. Then you stop. Then you start looking for other options. That hesitation is where shortages emerge. That stop is where panic starts. Now map that onto silver. New York is loaded relative to London because of that 2025 shift. London is the venue where a huge amount of institutional settling and promise-making happens. If London gets tight, historically there's been a pressure release. Metal can be pulled, borrowed, shipped, swapped. That's how the system keeps itself from snapping under strain. But tariffs create friction. They don't just add cost. They change incentives. They change the payoff matrix. They turn what used to be a two-way road into a road you don't want to drive on, especially on the way back. So what happens when London needs metal and the easiest pool is on the US side? At first, the banks try the normal tricks. They shuffle inventory classifications. They lean harder on leasing arrangements. They offer cash premiums instead of metal. They push paper around like it's the same as ounces. But eventually, someone shows up who doesn't want paper, an industrial buyer, a fund with strict delivery mandates, a sovereign customer, somebody who says, no, deliver metal. And then the question becomes simple. Can London source physical silver without blowing up the economics of the US side? Let's do the math. At roughly $90 per ounce, a 10% tariff is about $9 per ounce. That means any transaction that involves bringing silver into the United States carries that penalty. But even if you're shipping from the US to London, you now have to think about replacement cost. You have to think about whether you can restock what you shipped without eating the tariff on the way back. In other words, metal leaving US vaults becomes sticky, because once it leaves, it becomes more expensive to replace. That's the one-way valve effect. Now ramp that to 25%, and the valve tightens hard. At $89.94, 25% is $22.485. Call it $22.49. The economic gravity changes. A bank that lets 1 million ounces walk out of New York is facing a world where replacing that metal could cost an extra $22.49 per ounce. That's more than $22 million of added cost per million ounces. That's not a small line item. That's career-ending money. And here's where it gets really ugly. To make the old arbitrage flow rational again under a 25% tariff, silver would need to trade at a premium in the starving market that exceeds that tariff burden. The break-even level is simply current price times 1.25. That lands you around $112.43 per ounce. Let that sink in. $112 isn't a fantasy price in this framework. It's a mechanical threshold. It's the kind of level the market could print simply because that's the price at which moving metal becomes economically feasible again. Now, are we guaranteed to hit that? No. Markets are messy. Participants cheat. Rules get changed. Emergency measures show up. But what I am telling you is this. The tariff structure has set up a world where $100 plus dollar silver becomes a logical outcome, not because everyone suddenly loves silver, but because the system that normally prevents dislocations is being throttled. And this is exactly the kind of thing the mainstream media will miss until they can't ignore it. Because they're not watching spreads. They're not reading warehouse reports like scripture. They're not tracking EFP stress. They're watching the political theater. And political theater is always late to physical reality. Now, let me address the obvious pushback because I can already hear it. Oh, it's just a negotiating tactic. Okay, maybe. But negotiating tactics only work when the other side believes you will actually do it. If you announce tariffs and then carve out exemptions immediately, you've signaled weakness. You've made the threat hollow. And historically, when this administration uses tariffs as a lever, they don't do it with soft hands. They do it to inflict pain and force a response. Next pushback. The UK isn't in the EU. Correct. And irrelevant. The UK is explicitly included in the announcement. And that detail matters because the LBMA system's heartbeat is in London. You can pretend it's just Europe, but the hub is named. The hub is hit. Next pushback. COMEX will just change the rules. They'll cash settle. They'll raise margins. Yes, they might. In fact, I expect margin games. I expect rule talk. I expect attempts to cool paper price action. But here's the part people keep forgetting. Changing paper rules does not make physical silver appear, and London's obligations are not automatically solved by New York deciding to change its internal paperwork. If the problem is a physical shortage compounded by a logistics barrier, paperwork is not a substitute for ounces. You can't deliver a spreadsheet to a factory. Now, I want to make this practical, because the worst thing you can do is listen to a scary scenario and then do nothing except feel anxious. So here's the dashboard I'm watching over the next 2 weeks, starting the moment futures open. Number 1, margin requirement headlines. If you see big, sudden margin hikes, especially 20% or more, that's the exchange trying to smack volatility down by forcing leveraged traders to post more collateral or get liquidated. That can create sharp paper dips even while physical tightens. If you're playing paper with leverage, understand that the game can change overnight. Number 2, COMEX warehouse category shifts. There's registered metal, deliverable against futures, and eligible metal, stored but not committed. The important detail is how metal moves between categories. If registered starts draining or if large chunks are reclassified out of registered, that's a sign that deliverable supply is being protected. That is not bullish for shorts. That is bullish for anyone holding metal they can actually control. Number 3, EFP spreads, exchange for physical. When EFP stays calm, it suggests paper and physical are still loosely synchronized. When EFP blows out, it's the market admitting that metal is harder to source than the quote suggests. If that spread goes from pennies to dollars, the system is signaling stress. Number 4, London language. Watch the phrasing. When things get tight, the narrative shifts. You'll hear more about liquidity and less about inventory. You'll hear distinctions between allocated and unallocated emphasized like they're brand new concepts. You'll see journalists suddenly become obsessed with definitions. That's not education, that's damage control. Number 5, Greenland headlines. Any sign of talks stalling, any sign of pushback, any signal of a diplomatic freeze increases the odds that the tariff schedule stays intact. And every day closer to February 1st increases urgency. That urgency translates into premiums and into scramble behavior. Now, I'm going to tell you what I personally consider the key price zones, not as a prophecy, but as triggers for how I interpret behavior. If silver opens and quickly holds above $92, that's a signal that the market is beginning to price in the new friction. It would be a breakout from the lazy comfort zone where everyone assumes this will be worked out. If the mainstream media runs with, "it's just a bluff," and we dip into the mid-80s, I view that as the classic paper shakeout, the kind of move designed to scare people, to make them sell, to make them hesitate. And historically, those dips are where disciplined buyers get positioned. But if we see London-New York divergence, if physical premiums in one region start to separate materially from the other, then you're no longer in a normal chart environment. You're in a structural event. And structural events don't care about RSI or MACD. Now, here's something I need to say because it matters for your psychology. A lot of people in the silver world have been burned by hype. They've heard 1,000 "this is it" stories. They've watched spikes get smashed down. They've watched banks pull rabbits out of hats. And that creates cynicism. But cynicism can be dangerous because it can blind you to when the setup is actually different. This time is different in one key way. It is not primarily a demand-driven squeeze story. It's a supply chain and cost structure story. In prior episodes, when demand surged, the banks could lean on geographic flexibility. They could source from here, shift to there, borrow, lease, swap, and keep the illusion moving. The world was one big shell game, and the shells could slide across borders. Tariffs interfere with that. Tariffs don't just change price, they change the movement of the shells. And when you can't move shells, the shell game collapses into a single brutal question. Where is the metal, and who can actually get it? Now, let's talk about the industrial side, because that's the part almost nobody talks about in detail, and it's also the part that turns tight into panic. Investment demand is optional. People can choose to buy or not buy. They can wait. They can rotate into something else. Industrial demand is not optional. If you manufacture solar panels, you need silver. If you build electronics, you need silver. If you're producing specialized medical tech, you need silver. If you're in defense supply chains, you need silver. And you need it on schedule. You cannot tell your client, sorry, we'll deliver your order when the silver market calms down. So when industrial buyers sense a threat to availability, they don't negotiate with charts. They secure supply. They overpay if they must. They build buffer inventory. They sign contracts that look expensive in hindsight because the alternative is shutting down production. And when that industrial bid steps up, at the same time that metal is becoming sticky inside U.S. vaults due to replacement cost risk, you get an asymmetric move. Limited downside, explosive upside. That's how black swans form. They don't show up because everyone agrees. They show up because the system's normal safety valves fail. Now, I want to circle back to that 2025 inventory migration because it's one of the most ironic parts of this entire setup. The big players moved silver into the U.S. ahead of policy uncertainty. They believed they were defending themselves. They believed they were staying inside the castle walls. But if the walls now keep metal from moving out and being replaced at a reasonable cost, they've created a cage. They protected the inventory from one kind of risk, and they walked right into another. And here's the brutal truth. The people who set the trap are the same people who are now stuck in it, because the paper system relies on the ability to source physical when someone calls the bluff. The LBMA system in particular is not built like a simple warehouse where every receipt matches a bar. It's built on layers: allocated, unallocated, lending, leasing, settlement timing, and the assumption that the market remains liquid enough that any tightness can be solved by sourcing elsewhere. Tariffs make elsewhere expensive, and expensive becomes impossible faster than people expect. Now, if you're wondering, okay, what should I do? I'm going to be careful here. I'm not your advisor. I'm not giving you personal financial instruction. I'm telling you what I'm watching and how I interpret it. For me, physical silver is the core. The thing you can hold, the thing that does not require a counterparty's permission to exist. Paper vehicles can move faster, but they also come with rule risk, margin risk, settlement risk, changing terms risk. When events get chaotic, the paper arena is where the referees start protecting the integrity of the market, which usually means protecting the institutions. So my bias in a structural event is simple. Paper can be traded, but physical is the anchor. And if you are holding physical and you're tempted to panic because you see volatility on a screen, remind yourself, the screen is not your metal. The screen is a quote. The quote is a narrative. The metal is the asset. Now, I promised you cliffhangers and retention, so let me give you one that should keep you watching to the end. The moment that matters is not when silver hits $100 on a headline. The moment that matters is when we discover whether the system can still deliver metal at scale under the new cost regime. Because once the market begins to doubt deliverability, premiums can detach from spot, and that's when the average buyer gets priced out. Not by spot price, but by availability. So here's my question to you. Have you tried buying physical silver recently? What premiums are you seeing in your area? Over spot, under spot, delayed shipping, any weirdness? Drop it in the comments because crowdsourced real-world data beats media narratives every single time. And second question, do you think the tariffs actually stick through February 1st, or do you think exemptions show up at the last minute? I want to see where your head is and why. Now, quick intermission, and this is the creative cross-channel intro I promised. If you're someone who wants silver-related success stories, real people, real wins, what they did and what they learned, I've put a link in the description to another channel that focuses on that angle. Go check it out and subscribe over there too, because seeing how others executed can sharpen your own decision-making. All right, back to the storm clouds. Let's imagine two paths from here. Path 1, the market shrugs. Commentators keep calling it posturing. Traders assume it gets negotiated away. Silver chops around, maybe dips, maybe bounces, nothing dramatic. Yet. In that path, the danger builds quietly. Because physical flows don't need the whole world to panic. They just need a few large participants to pull inventory off the table, a few industrial buyers to lock supply, a few banks to decide replacement risk is too high. And then one day, a routine delivery request becomes a problem. Path 2. The market wakes up fast. You open the week. Spreads widen, EFP flares, premiums creep, and suddenly the same voices that told you this was nothing start screaming that silver is overheated and speculative and due for a pullback. That's when the scare stories arrive. That's when the top collar industry emerges from the shadows, telling you to sell before you lose everything. And you need to understand that those stories usually have a purpose, to push metal out of weak hands and back into the hands of the people who need it. The people who can't afford to have retail holding too much physical, because every ounce you own is one less ounce they can shuffle around. Now, let me give you the most important strategic insight here. The banks are not terrified of silver being expensive on a screen. They are terrified of silver being unavailable. High price can be hedged. High price can be managed. A price chart can be traded around. A broken flow cannot. A market where London cannot confidently source physical without punishing replacement costs, where New York becomes a sticky reservoir, creates a kind of stress that derivatives cannot magically dissolve. And when you combine that with the fact that silver inventory is not infinite, and that silver is consumed industrially, not just stored, you get a setup where a small policy wedge can amplify into a much larger event. Now, I want to put numbers around the required premium idea, because this is where people finally grasp how mechanical this is. At a 10% tariff, the market needs roughly a 10% price advantage, plus shipping, plus insurance, plus timing, to justify moving metal in a way that doesn't leave someone stuck with replacement pain. That's already a big hurdle, because silver arbitrage margins are usually thin. At 25%, you need roughly a 25% advantage, which at $90 is that $112.43 zone we calculated. So if London is short and needs US metal, London would have to trade materially higher to coax that metal out, because the US side will not want to bleed inventory that becomes much pricier to refill. That's why I've said from the start, this is a one-way valve dynamic. Metal can leave, but it doesn't want to return. Replacement becomes toxic. Now, here's where it gets spicy. If the LBMA system can't source metal easily, it has to choose between three ugly options. Option 1. Allow the London physical price to run, hard, until enough metal comes out of hiding. That means $100 plus dollars is not just possible, it's used as a rationing mechanism. Option 2. Push participants toward cash settlement or equivalent settlement. In plain English, pay people in fiat instead of metal. That would be the moment confidence breaks for a lot of institutions that assumed their contracts were as good as bars. Option 3. Invoke force majeure language. Basically, we can't deliver due to circumstances beyond control. Even if they don't use that exact phrase, the effect would be the same. Delayed delivery, substituted settlement, restructured terms. And every single one of those options is bullish for physical metal holders, because each option admits that metal is scarce relative to paper claims. Now, watch what happens psychologically if option 2 or 3 even gets whispered. The average person with an ETF position starts asking, wait, do I have silver or do I have a claim? And then they look for physical. And when millions of people look for physical at once, the spot quote becomes almost irrelevant. Premiums do the talking. That's why I keep saying, the move that hurts people is not the move on the chart, it's the move in availability. Now, let's talk about what I think happens this week specifically. I expect volatility. I expect narrative warfare. I expect experts to suddenly discover that tariffs are bullish for the dollar and bearish for metals, and to repeat that line as if it ends the debate. But the dollar narrative is a surface narrative. It's a first-order effect. The deeper effect is the one-way valve and the physical flow disruption. So if you see a short-term paper dip, do not automatically assume the danger has passed. Often, the most dangerous moment is when price looks calm while the structure deteriorates. Now, there are two big tactical events I think we could see quickly. 1. Margin manipulation. If silver begins to sprint, the exchange can hike margins and shove weak leveraged longs out of the market, creating a violent downdraft. That doesn't fix physical tightness, it just resets the paper positioning. 2. Media narrative pivots. When the institutions are under pressure, the public narrative changes from silver is rising to silver is risky. Suddenly you'll see stories about massive selling pressure, overbought conditions, speculators, froth. The goal is not to inform you. The goal is to make you doubt your own eyes. Now, I want to add something here that I think is important for community building, because this channel is not just about charts, it's about people. If you're doing well financially, if you've had a good year, if you've made smart moves, share a quick success note in the comments. Not to brag, but to help others. Because seeing real people win keeps morale high, and it reminds everyone that smart positioning beats panic. And again, for the people who want deeper work, we do offer members-only videos. There's a separate team helping on those, and the research goes further than what I can always fit publicly. If you want that level of detail, check the membership link in the description. Now, let's zoom out for a second and answer the big question. Why does this feel like a black swan setup? Because the market is not pricing it yet. The market is acting as if this is a headline, not a structural shift. Most participants are assuming the old flow remains intact. They assume London can always source. They assume New York can always ship. They assume the pipes remain open. But tariffs are a choke point, and choke points create nonlinear outcomes. You don't get a smooth response. You get pressure, then more pressure, then suddenly a break. And if you're the person who waits for proof, the proof arrives as a higher price and empty shelves. So the next 14 days matter. 14 days until February 1st. 14 days of negotiation theater, headline games, and behind-the-scenes repositioning. 14 days for the biggest players to decide whether they protect inventory or risk replacement pain. And here's the part nobody wants to say out loud. If the people controlling large pools of physical decide that metal is too valuable to release, it doesn't matter what the screen says. The physical market becomes its own universe. Now let me give you my practical battle plan mindset. Not actions, but mindset. 1. I do not chase headlines. I chase data, warehouse reports, spreads, delivery signals. 2. I assume the first move is designed to confuse me. If price surges, expect a smash. If price dips, expect a narrative push. The goal is always to create emotional decisions. 3. I separate paper volatility from physical reality. Paper can be whipsawed. Physical is about availability. 4. I keep my eyes on the replacement cost problem because that's the core of the one-way valve. And 5, I keep cash ready for opportunities because in chaotic environments, the best entries often appear when fear is being sold to you as news. Now, I want to end with something that might sound blunt, but it's true. One last thing. Tomorrow's open isn't just another candle. Watch the first hour. If spreads widen while price stays calm, that's the tell. Calm price with stressed plumbing is the warning siren. And if you catch any weird dealer delays, post them. We'll map it together before the crowd even notices anything. Most people will miss this, not because the information isn't available, but because it's not packaged in a way that feels urgent to them. They'll wait until a major outlet runs a front-page story. They'll wait until their friend texts them. They'll wait until the chart looks obvious. And by then, the move has already done the damage. So here's your final recap. Silver is sitting just under $90 on Sunday evening, January 18th, 2026. A tariff schedule has been announced that hits key European nations in the UK starting February 1st at 10%, with a potential escalation to 25% by June 1st if Greenland negotiations don't produce a deal. That tariff structure threatens to create a one-way valve effect for physical silver, making U.S. vault inventory sticky because replacement costs become punitive. If the normal arbitrage flow between New York and London is disrupted, the global pricing mechanism can decouple, and a $100 plus dollar physical market becomes mechanically plausible, with the 25% break-even level sitting around $112.43 at current pricing. In the next 14 days, the signals to watch are margin games, warehouse category shifts, EFP spread expansion, narrative pivots from London, and any Greenland headline that suggests talks are stalling. And through it all, remember, the banks fear unavailability more than they fear high prices. So do me a favor. If you're still watching, hit subscribe. It's one click. It matters more than you think. Check the bonus links in the description, including the premium WhatsApp channel and the membership link if you want the deeper research. And drop your answers below. What premiums are you seeing, and do you think these tariffs actually stick? Take care of yourselves, take care of each other, and I'll see you in the next one, because I have a feeling the next update is going to look very different from this one.